Welcome to the Sunday paper. We saw the S&P 500 trade sideways for most of the week in anticipation of the Nvidia earnings release. After Nvidia reported on Wednesday, we saw SPY dip to 553.38 before returning to and breaking out of its 20-day and 50-day moving averages of 560. GDP revision came out on Thursday, revised up to 3.0% from the previously reported 2.8%. Revision invited a late sell-off in stocks on Thursday as the market tried to reprice a 50 basis point cut from the Fed to a 25 basis point cut in September. Core PCE data came out on Friday at 2.5%, in line with expectations and still in a downward trend as inflation continues to return to the 2% target outlined by the Federal Reserve. PCE is the personal consumption expenditures, different from the CPI, as PCE measures rural spending and government spending, and the CPI does not. The Federal Reserve has said they weigh the change in PCE rates more than the CPI when considering rate policies, but they still consider all three inflation gauges, CPI, PCE, and PPI, together when making decisions on interest rates. With the limited economic news and earnings season wrapping up throughout this past week, SPY ended the week at 563.55, nearly flat from the Monday open of 563.15. On Wednesday, we finally got the Nvidia earnings that we've been waiting for. Nvidia stock sold off nearly 10% as Jensen Huang and Company reported their earnings for their second quarter for fiscal year 2025. Revenue came in at $30 billion, up 15% from last quarter and 122% from last year. Income increased 12% for the quarter, but expenses increased 12% as well, and the margins contracted from 78% to 75%. The market was excited for the debut of their Blackwell chip, but Wang threw cold water on the hype when he announced that the chip would be delayed and would not have the level of computing power as previously promised. Wang debuted the chip on March 18, 2024 at the NVIDIA Investors Conference, and at that time, NVIDIA stock was meeting resistance in its stock price at $95 a share. The stock continued to trade at that resistance level throughout the following quarter, but broke out in May as Wall Street expected the Blackwell chip to be the catalyst for greater earnings in the August report. NVIDIA did declare delays in the Blackwell chip before their August earnings, which contributed to the slide in its share price from 140 in June to the present price of 119. But those delays were noted as NVIDIA not being able to make the chips as strong as they wanted to make them, but still as strong as they announced they would be. The chips were still prepaid for by the major purchasers, Microsoft, Meta, Tesla, Alphabet, and Amazon. There was a contraction in the margins in NVIDIA's earnings, meaning that the money came in, but the company spent more than expected on production. NVIDIA chips are manufactured by Taiwan Semiconductor. And because of that, NVIDIA reported a higher operating expense. NVIDIA closed the week at 119.25 a share, pivoting around its 20-day and 50-day moving averages. We adjust the view to a 1 week close, NVIDIA's 20-day moving average is down around 112. Stocks sometimes experience churn around their moving averages, so pay attention to these levels for directionality. But NVIDIA isn't losing money, they're still growing. Wang says volume production will ship in their Q4, which will be spring 2025, and we should see it appear in the 2026 Q1 earnings, which will come out summer 2025. They may not warrant the outsized growth they've previously experienced, 100+% each year, but they're not going out of business. There's still plenty of upside potential in NVIDIA. We're still on Fed watch. One of the biggest things looming in the markets is the coming rate cuts by the Federal Reserve. The Fed began raising interest rates due to the spike in inflation in 2022. But now that inflation has cooled down, the Fed is preparing to systematically cut interest rates to a more normal level. The overnight Fed funds rate determines how much banks must pay to borrow money. A lower yield means banks must pay back less money to borrow money. The less money paid, the more money banks have to lend to the public. Money circulating through the economy typically creates a weaker dollar. The dollar itself isn't as valuable when there are plenty of them to go around. Or in other words, if you have a can of Pepsi soda, it costs $1. That dollar is worth 90 cents. That means it now takes $1.10 to buy that same can of Pepsi. So cutting interest rates creates a weaker dollar, which in turn creates a higher nominal price for products, nominal meaning the price is not adjusted for inflation. And looking at a 1 year chart, the dollar is closing in on its 200-day moving average. This has oftentimes worked as a level of support, but now that the Fed is preparing to cut rates, we could see this become the level of resistance. The next Federal Open Market Committee meeting, the Fed meeting, will be September 17th through 18th. We'll be watching the value of the dollar via DXY between now and then to see if it will hold support at 150 or if it'll begin to break down to sub 100 levels ahead of the rate cuts.